Hey everyone, it's Moshe. I'm back with you. It's about 3:30 on Wednesday afternoon. Big day today, Fed decision. We all knew it. Most of the financial market had already priced in that the Fed is going to hike their rates by 50 basis points at 0.5%. This is kind of what I've been talking about over the last day or two. And now that kind of the news is done, they came out today. They hiked rates by 0.5%. Had their printed testimony as well as a question and answer session by Jerome Powell, who is the Fed chair. We did see quite, as it is typical on days like this, there is a tremendous amount of market volatility, big swings up, big swings down. Again, a lot of it is just dependent on how the market and the traders are perceiving what the Fed is saying, looking into it, like dissecting the words and verbiage and how it changed based off of their previous meetings and their forward projections and all of this stuff, which is kind of really hard to digest, dig into. But luckily we've got a lot of people that are much smarter than me and able to dissect this stuff for us and share it with us, so then I can in turn around and share it with you guys. And the biggest takeaway is kind of like what we discussed, the actual raising of the interest rates by themselves, contrary to popular belief, actually help the mortgage-backed securities market settle down over time. And we do typically see that interest rates improve over time after the Fed announcement, the decision to hike rates. And this is really the first time that they've done it, I think in like 20 years, right? So just to kind of put things into perspective, I want to share with you guys the chart. And again, this is the chart of the mortgage-backed securities market. As you can see, this is kind of like since the start of the year, right? So since coming into 2022, mortgage-backed the securities, the 4.5% coupon. Again, a lot of this stuff is just mortgage talk and jargon. Doesn't really make a difference. Like, you don't necessarily need to understand the 4.5 coupon and all this stuff, but just to kind of paint a picture, the year started off with this coupon trading right around 107.1, right? So and fast forward to yesterday, which we kind of see this major down day, right? The red candles indicate a downward movement in the mortgage-backed securities, which equate to higher rates. And the green candles equate to move up in the mortgage-backed securities, meaning that there is more value to these securities and to these bonds, which typically correlates to lower rates ahead. Keep in mind that this really doesn't necessarily change day to day, but sometimes it does, sometimes it doesn't. As you can kind of see, like, literally since from January to February, not that big of a deal, but we see over here February, we have a couple of big down candles, broke down some levels of resistance, and then really since February, we're in this long downtrend up until yesterday, which we kind of tested some levels of support, broke beneath it here. I think the coupon ended at 100.84, something like that, very close to that. Today, again, very up and down. If you see here, the skinny part of the candle kind of shows you how low things got, and I think it got a little bit worse than this. And then the top also means it got a little bit higher intraday, but basically closed here. As we can see, the coupon closed at 101.80, up 59 basis points from this morning when trading opened up. So in short, it was a fairly decent day for the mortgage-backed securities market, reason being twofold. Number one, the market really saw, and after the question and answer session by Jerome Powell, we got the sense that they are in this to do what it takes. They're committed to bringing down inflation, right? Which, again, like what we discussed yesterday, is the arch enemy of bonds, right? If you were to imagine that you are an investor in a 30-year mortgage coupon, that means you're putting in $1,000 today with the hope that you're going to get a rate of return of $1,000 in the future. The reason that inflation goes against these assets and causes interest rates to go up is if in time the investor is of the mindset that inflation will continuously go up. So their $1,000 return on their initial investment is no longer going to be able to buy them the goods that they want, right? If you walk into the store today or you went to the gas pump, your $1,000 is not going to go as far as it did last year or 2 years ago or 3 years ago. So when the investors and when the market in general sees that the Federal Reserve is doing whatever it takes, or they're saying that they're doing that, they will do whatever it takes by hiking a 0.5 point today and coming out with their statement and telling us that they are in this to win it, so to speak, to do whatever they can to bring inflation down to the more normalized 2% a year. That ultimately will dictate that hopefully up ahead we will see lower mortgage rates come up. And I think one of the main things that Jerome Powell said was, I think he was asked that there's been a lot of talk about maybe a 0.75% of a hike at some point in one of these meetings, which I think one of the other Fed members, I think it was about a month or so ago, had actually indicated that, hey, you know what, maybe 0.75 is not off the table. And I believe that day and following since, the market just threw up all over itself, and we saw interest rates go up heavily after that comment. But today's statement by Jay Powell, as we call him, kind of settled things down, and we did see a major rally in the mortgage-backed security. So just to kind of tie it up, like in the end, nobody really knows what's going to happen, right? But and most likely this will not be in a straight line. We're going to probably continue some major volatility tomorrow, the next day, over the next week or two. But over time, these things ultimately will settle into place. We will see a more normalized interest rate environment going forward, as opposed to the one that we've been kind of experiencing over the last 30 to 60 days, where it seems like every minute the rates are going up. So in terms of just like advice, if you're a prospective home buyer looking to purchase a house, I highly suggest that you speak to your lender at length. See if they have an extended rate lock program that they can offer you that allows you to lock in the rate today, shop for a home, get under contract, and if rates improve, maybe they have a renegotiation policy that you can put into place. Essentially what this will do is safeguard you against the market volatility over the next 30, 45, 60 days while you're out shopping for a home. Ultimately, a lot of people are of the mindset that at some point the US economy will go back into a recession. And as history tells us, during recessionary periods, we see lower interest rates. So the one thing that I can convey is, if the deal makes sense and if you can afford your monthly payments, don't let the sticker shock of the interest rates being 5%, 5.5% today scare you away from buying your dream home. Because at some point in the future, we will see interest rates lower. And the sooner you get into your house, the sooner you own your real estate and you're on the right side of real estate appreciation, which means you own a house today, it will likely, based off of the data that we're seeing, go up in value over time. So the sooner you buy it, the more equity you can build, the more financial wealth you can build. And interest rates are going to be cyclical. They're going to go up, they're going to come down. And at some point when they do come down in the future, then you can take advantage, refinance, and get a lower rate going forward on your loan. I hope you found this to be insightful. If you have any questions or comments, feel free to comment below, reach out. I'd be more than happy to discuss it with you. Thanks. Bye-bye.